When future history books are written, they will describe this time as one marked by a very sharp rise in prices. This happened mainly because of big supply chain problems caused by the COVID pandemic and the war in Ukraine. At first, the increase in prices felt like it was coming down slowly. However, when you look at the charts later on, the drop in prices will seem to have been very quick. In fact, many believe that we will soon move into a period where prices fall rather than rise, what is known as deflation. An editorial by a well-known writer in a major financial newspaper explained that the central bank will soon be blamed for pushing us into a deflationary period. We are already seeing some warning signs. For example, a major home improvement store is reporting that sales in its stores are down by 3 to 5% for the year. Many companies expect that they will face serious problems soon because they will sell fewer items and have to lower their prices. More companies are now mentioning these problems in their quarterly reports. Traditional economic statistics such as gross domestic product were created during the industrial age and may not work well in today's digital world. Instead, we look at measures like gross domestic income, which often gives a more accurate picture. Even with these new ways to measure the economy, there is a great deal of uncertainty. One thing that worries me is the idea that when the market goes down, our investment strategies are hurt much more than we expect. Many people panic when they check their accounts every day. We often remind ourselves that our investments are planned for the long term, typically a 5-year horizon. When the central bank changed its message from inflation is temporary to it might not be temporary, it unsettled the markets. This change made many investors rush back to the familiar benchmark indices. Our strategy, however, is different. We choose stocks that are not part of the broad indices, so when investors start selling off those stocks to return to the indices, we tend to do the opposite. We look forward rather than backward, focusing on companies that we strongly believe in, even if they have been hurt by recent market events. Our portfolios have included stocks that did well during the coronavirus crisis. The point is that the world has changed permanently because of the move toward digital technology. We are not returning to the old ways. Some of the current problems in the market might be caused by people selling stocks to claim tax losses, a process that is likely to settle soon. Another problem could be that many investors have used borrowed money to buy stocks, and that debt is now being forced to unwind. In recent times, we have seen a cleanup in the market as these issues have come to light. At our regular meetings, many of the experts agree that most people have never seen true exponential growth. They have not seen the kind of rapid upward trend that can happen when several areas such as robotics, energy storage, and artificial intelligence come together. When one strong growth trend helps fuel another, the result can be massive. For example, in the future, there could be a huge market for self-driving taxi services. The combination of new technologies may create a situation where revenues grow from nothing today to as much as $10 trillion by the year 2030. If this happens, any company involved in that area could see extraordinary return. It is also important to understand that much of the trading we see today is done by computer programs or algorithms. These algorithms base their decisions on past data and do not really take the future into account. In fact, more than half of the trading volume in the markets is driven in some way by these automated systems. This reliance on old data means that many decisions may not be the best when the future is uncertain. There is also growing concern about the labor market. Many experienced professionals who have run large companies find the current situation puzzling. They see that new trends driven by digital technology, new financial systems, and even new types of online assets are likely to change the job market in ways that are hard to predict. Because of this, we are planning to research these changes much more in the future. Looking at innovation stocks, we have noticed that many of them are now trading at a fraction of the prices they reached earlier this year. We believe that these stocks could be the big winners in the near future once it is confirmed that current high inflation is only temporary and that there is a real risk of recession. When fears of a recession grow, stocks that are considered valuable sometimes fall sharply. I do think that there is something real behind this idea, and we should be ready for that. These ideas are not just our own strategies. Other portfolios that focus on new and innovative companies are likely to see similar opportunities soon. For example, we estimated that our own strategies would deliver a 15% compound annual return over the next 5 years. That means the value of our investments would double over that period. This is nearly twice the return that the general equity markets usually provide. Today, if our stock valuations drop to levels similar to those of the big technology companies of the past, we believe that our combined strategies could yield nearly a 40% annual return, which would mean the value would increase by 5 times in 5 years. In other words, we are much more confident now than we were in February about the future of our investment. One of the lessons we have learned over time is that even when markets look shaky, having a long-term perspective can help you avoid panic. We have always maintained a 5-year investment time horizon. This approach helps us ignore the daily ups and downs and focus on where the market is headed in the long run. Although some investors try to predict every small change in the market, our experience shows that it is far more effective to focus on the future and to stick with high-quality stocks that we believe in strongly. During times of uncertainty, many people worry about their day-to-day investments. But it is important to remember that the true measure of success comes from the long-term growth of the companies you invest in. The economic statistics that are released regularly are often outdated and can miss important changes that happen quickly in our digital age. That is why we pay more attention to measures like gross domestic income, which seems to reflect the real state of the economy more accurately. One of my biggest concerns is a market downturn that might hit our strategy harder than expected, causing panic selling. However, we stay calm and focused on the long term, knowing that market corrections often create opportunities to buy strong companies that have been hurt more than necessary, trusting their fundamentals to drive recovery. As the market becomes more volatile, many investors are still learning to adapt. Some are forgetting lessons from past cycles and aren't ready for the fast changes brought by digital technology. I've seen market shifts reveal opportunities that weren't obvious before. The key is to focus on long-term trends and invest in companies with a clear future vision. For example, Tesla is not just a car maker but also a tech leader, building a network for self-driving taxis and gathering real-world driving data. This gives Tesla a strong edge over other auto companies and shows how innovation can change a market. Even though many trades are driven by algorithms based on past data, human judgment remains essential. A careful, thoughtful approach to investing means looking beyond the numbers to understand a company's true potential, including the vision of its management, the quality of its ideas, and its ability to adapt. I'm confident that digital transformation is creating new opportunities that many have yet to see. Just as some investors missed the tech boom, many innovations remain unrecognized, and patient, informed investors can benefit as these companies grow. However, we must be realistic about the risks. Not every new idea will succeed, so take careful, calculated risks, understand the downsides, and adjust your strategy if needed. With rapid change, traditional measures of the economy may no longer be accurate. Supply shocks and the risk of deflation show that we're in a period of transition. The best approach is to stay calm, focus on long-term goals, and invest in companies with strong fundamentals and clear plans for the future. As you plan your financial future, remember to think long-term. Look for opportunities in the midst of market corrections, and be patient. Even though short-term data can be misleading over the long run, a careful and informed strategy will help you achieve strong return. Always do your research, listen to the advice of experienced professionals, and stay true to your own judgment. And if you enjoyed this video, please like and subscribe for more clear and simple explanations on how to navigate these challenging times.